Hello and welcome to episode 47 of the Special Situations Report, a podcast by Inside Arbitrage covering the most intriguing event-driven activity over the past week. My name is Asif Suria.
And my name is Tamanna Suria.
And what we will cover on this podcast today is just a small part of what happened in the special situations world last week. For daily updates and alerts on special situations, as well as access to tools that help you identify opportunities, such as our merger arbitrage tool, check out insidearbitrage.com. Please also take a moment to like and subscribe to this podcast on whatever platform you may be listening on.
During this Thanksgiving holiday weekend, we wanted to focus on two key stories, including an interesting insider purchase of DoorDash by Alfred of Sequoia Capital and the various spin-offs of Honeywell. Before we begin, we want to state that nothing on this podcast is meant as investment advice, and please refer to our full disclaimer at the end of the podcast for more details.
Yeah, this week was generally quiet. We didn't see a lot of M&A activity or spin-offs being announced. So we figured we'll focus on two stories. One of them was actually quite fascinating for me because I noticed that DoorDash, the delivery platform that a lot of people use either to deliver restaurant food or groceries, ended up seeing an insider purchase of $100 million by Alfred, who's the director of the company. A lot of people might be familiar with Alfred because he's a partner at Sequoia Capital, the premier VC firm in Silicon Valley, and has been on the board of DoorDash for over 10 years at this point. Back in 2013, when DoorDash was originally trying to raise capital, Sequoia Capital had decided to pass on investing in the company. But in 2014, they changed their minds and led a Series A investment into the company. As a result, Alfred joined the board of directors, and he's been serving there for, as I mentioned, almost 11 years at this point. We've seen that Sequoia did not sell any stock of DoorDash when the company went public in December 2020, which is highly unusual. What you would normally see is if a venture capital firm is invested in a company and it's going public, they would sell in the IPO and distribute the shares or the proceeds from the sale. In this case, Sequoia not only did not sell stock, they actually bought some during that IPO period from different funds. We once again saw Sequoia buy stock in March of 2022. During the time, as you might recollect, there was this big downturn in tech stocks after we saw huge increases in interest rates due to inflation spiking up post-COVID. And so during March 2022, we saw Alfred through Sequoia step up and buy $50 million worth of DoorDash stock. And these prices were in the low $80s to $90 price range.
Yeah, it's interesting to see Sequoia Capital pick up shares of DoorDash time and time again. Especially, as you mentioned, it's unusual to see these firms actually continue to buy shares instead of selling off their stake, because the IPO is traditionally treated as an exit. And especially if Sequoia invested in their Series A round, they've been there since practically the beginning. Maybe not Y Combinator stage, but shortly after. So it's interesting to see their continued purchases, and also Alfred fits the stereotype of an insider we tend to look out for most often, right? Directors with an investment background who have been serving on the board for quite some time.
That's exactly one of our favorite kind of investors. When you said stereotype, you're talking about an independent director who's been on the board for a long time with an investment background. And where have we seen that before? I think you're probably thinking of Jay Hogue in the back of your mind, who also is with Technology Crossover Ventures, or TCV as it's called now. And for about 13 years at this point, we've been writing about how Jay Hogue has stepped in time and time again, buy stock of Netflix when the stock has been weak, either because the company made a mistake, like they were trying to spin off their DVD rental business at one point in 2012, or when there has been general market weakness. So we've seen Jay Hogue, and he bought stock of both Netflix and Zillow and ended up doing very well. So when I saw this purchase by Alfred of Sequoia, that's exactly what I was reminded of. Here is a venture capitalist. He's buying stock in a tech company. They've been on the board for a long time, and they've had an investment since the very early days of this company. So what's interesting this time around is in 2022, they bought about $50 million worth of stock. This time around, they're buying $100 million worth of stock. But the stock price has also doubled. So in terms of the number of shares that they ended up purchasing, it's not double the amount of shares. They're putting in twice the amount of money into buying DoorDash stock. Now, the other fascinating thing is each week we write an Insider Weekends article and we focus on 5 top insider purchases and 5 top insider sales. DoorDash actually made it on both lists. So it is there on the insider buying list as well as on the insider selling list. And this is because while Alfred Lin through Sequoia was buying stock, the other insiders, 8 of them, were actually selling stock, including the CEO. So I took a closer look. I was like, this might actually be a negative signal to see all these other insiders sell stock. But some of them were selling stock after exercising options or RSUs. So they must have had RSUs that vested and they're selling stock because of that. And in some instances, the filings are actually wrong. You and I have seen this where with Palantir insiders, instead of filing it as a transaction code F, which is an automated sale to cover tax related to exercising of options or RSUs, they end up filing it with a transaction code S, which makes it look like it's an actual sale. The same thing happened with a few of these DoorDash transactions. So it looks like a real sale, but it isn't. So not as much of a negative signal as I originally thought. And so this insider purchase by Alfred Lin still stands out in that regard. Going to the company, I was looking at DoorDash in the context of Lyft, which is a company we wrote about 2 months ago. And if you recollect, we talked about how Lyft has not entered into the food delivery business, either through groceries or restaurants, like Uber Eats has done. And one of the reasons is they've chosen to partner with DoorDash rather than go it alone in that vertical. And so when you look at DoorDash, they are, a little less than half the size of Uber. So Uber has a market cap of over $185 billion. DoorDash is about $85 billion. So quite a bit smaller. But they have also been doing what Uber has done. So they've gone out and purchased Deliveroo as well as Bolt in Europe. And so geographically, they've expanded into Europe through these acquisitions. They've also acquired a company that lets them do restaurant software and reservations. So they're getting into that side of the business, kind of like what Toast does. So Toast is not just a payments company for restaurants. They also do other restaurant software, which is what lets them lock in these restaurants. So DoorDash is doing that as well. So this is a company that is firing on all cylinders through acquisitions, through internal investments. And you can see that in the numbers. So their gross order volume, or GOV as they like to focus on, was up 25% last quarter when you look at it year over year compared to Q3 of 2024. On top of that, sales revenue, as they recognize it, was up 27% year over year, and net income was up 48%. Now, I'm not talking about, adjusted EBITDA and adjusted this and that. I'm talking about real GAAP net income. It was up 48%. Despite all this, the stock sold off 27% over the last 2 months. And one of the reasons behind this is they did miss their earnings estimates by a few cents. They did also see a sequential decline in net income from Q2 to Q3 of this year. And more importantly, they guided towards potentially spending hundreds of millions of dollars on their platform and investments in 2026. So the market is a little bit worried that yes, this company is doing very well, revenue is growing, but maybe the bottom line and net income that investors would see is likely to be muted, at least in 2026, while the company makes additional investments both in M&A and investing in their platform.
So, what do you think of DoorDash at the moment? Do you think the company's worth considering, worth a deeper look, like we said for Lyft a couple episodes back on our interview with Evan Tyndall? Or do you see something else in the company's future that may be worth paying attention to?
I had not really thought about DoorDash a whole lot until we looked at Lyft. But when I look at it now in the context of how well they're growing, how focused the management team is, how much support they have from a long serving director, it changed my mind a little bit. The key concern I have, as most investors probably have, now that momentum is essentially muted these days and momentum stocks have come down quite a bit, is that the stock is very expensive. It trades at nearly 38 times free cash flow. Can they grow into that valuation? I think they can. They're trading at a forward price per sale of about 5 times. If you think of them more as a software company with gross margins at this point are over 50%, then maybe that 5 times sales is not that expensive, but it'll take them some time to grow into this valuation that they have. So I'm very much interested in the company. I'm going to add it to my watch list. I'm not that excited as to want to buy a position in the company right now. I would personally favor Lyft over DoorDash at this point.
Yeah, that makes perfect sense, especially in a market where momentum stocks have kind of seen a downturn as of late. It doesn't make as much sense to invest hoping for a momentum story, waiting for it to fill in the shoes that the valuation is set. Makes a little bit more sense.
Absolutely. So tell us a little bit about Honeywell. This is the company you've been focused on both for the last newsletter as well as this newsletter. So tell us a little bit about what you're finding in these Honeywell spin-offs.
Yeah, exactly. And that's a great transition over to our second story for the week. And that is the Honeywell spinoffs, as you just mentioned. So we've actually talked about Honeywell multiple times on this podcast before, but we never quite dived very deep into the business itself and then what value lies in the RemainCo after the completion of the Solstice Advanced Materials spinoff. Now, before we get into Honeywell as a company, we have to start with what drew us to the thesis in the first place. Now, a little over 2 years ago, we wrote our June 2023 monthly newsletter, with one of the spotlight ideas being General Electric, or GE as it is better known. This was a few months after the completion of the GE Healthcare spinoff, as part of a massive restructuring at GE to reduce gross debt and refocus on its core businesses. The three spinoffs were GE Healthcare, which would encompass the healthcare business segment, GE Vernova, which would encompass the power and renewable energy segments of GE, and the remaining company would be GE Aerospace, the legal successor, and a company solely focused on aviation and aerospace activities. GE Vernova at the time was actually reporting massive losses, and our initial thesis was that the true value was with the aerospace business. In some sense, our thesis was both right and wrong. We sold our shares in the model portfolio in the parent company GE in late March 2024 after making a nice 72% gain. Now, I continue to hold both the RemainCo GE Aerospace and the spin-off GE Vernova in my personal portfolio. Now, much to our surprise, GE Vernova's stock price rose by over 325% post-business separation. The parent company, GE Aerospace, has performed quite well as well, up about 125% post-spin, I believe, but by no means were we expecting the levels of success that GE Vernova has experienced. Now, this lesson about spin-offs was at the forefront of our minds when we came to the Honeywell situation, and we were by no means the only ones to draw comparisons between the two businesses as well, which we'll dive into in a second.
Absolutely. So I held on to GE as well in my personal portfolio, but I did sell GE Vernova last year. It was already up quite a bit. And as you pointed out, our original thesis was not to hold on to Vernova. I just got lucky with it for a period of time. But that lesson taught me to stick with Western Digital and SanDisk when that spinoff happened this year. So I was able to apply that lesson to holding on a little bit longer to the Western Digital spinoff. But to your point, you're right. The experience with GE is what drew us to Honeywell. And then there was this activist fund, I think, that wrote a letter to Honeywell that you've mentioned in the past.
Right. But before we get into any of that, we should probably cover what exactly Honeywell is. As we implied with the comparisons to GE, the company holds a very broad portfolio of market-leading assets that span industries such as aerospace and defense, industrial automation, building automation, and energy and sustainability solutions. In fact, those are the four main business segments that the company operates under. And they are fairly self-explanatory in terms of what they do. Aerospace Technologies is a supplier of various aircraft products, parts, software, and services. Industrial and building automation offer various control products and safety solutions. And then Energy and Sustainability Solutions focuses on material sciences and processing solutions with a focus on the transition to green energy. The Sustainability Solutions business segment was actually where the Solstice Advanced Materials spin-off lay, and that business focused on refrigerating and heating solutions, as well as various materials for semiconductors, armor, and medical uses as well, so quite diversified there. The unit was the first of the Honeywell spin-offs to complete and actually began trading on October 30th. Post-spin, we haven't seen much price action, with both the parent and the spin-off falling about 2 to 3%. But that's understandable considering that Honeywell's full year fiscal guidance for 2025 hasn't been impacted by the spin-off of the advanced materials business segment at all, considering it was such a small part of revenue. Now, Solstice isn't as interesting of an opportunity as the RemainCo due to its highly capital-intensive nature, flat guidance, and large debt balance as a result of the spin-offs, as well as middling free cash flow generation, which will make paying down the debt difficult. Now, as we've discussed in prior episodes, now that the Solstice spinoff is completed, Honeywell Aerospace is next on the list, with an estimated separation date of the second half of 2026. The RemainCo post the Honeywell Aerospace spinoff will include both the automation business segments as well as some remaining pieces of the energy and sustainability solutions business, though they will contribute far less to revenue comparatively. Now, we are not alone in seeing more value in the RemainCo, especially in that aerospace division, which is what the activist Elliott management called the crown jewel of the business. And that's what you were hinting to earlier when there was this mysterious activist who had a stake in Honeywell. We've talked about Elliott's involvement in Honeywell multiple times on this podcast before.
Yeah, so what makes the aerospace division so interesting?
So, Honeywell has managed to dominate market share as a top 5 global commercial aerospace supplier, and they've also benefited from a long tail of captive aftermarket sales. However, the success of the aerospace division has been overshadowed by operational and then macro headwinds in the automation business segments. And that's a problem we see at many conglomerates, which once again makes the case for why these businesses should be spun off. Now, during Q3 2025, Honeywell as a whole saw overall sales growth of 7% when compared to the same quarter last year, but these results were bogged down by the 9% decline in the industrial automation business segment. However, the aerospace business segment managed to report 15% growth year over year, and that's also including strong organic growth of 12%. So it's not as if M&A is what's driving results in the aerospace business segment. This strong growth, combined with a best-in-class margin of 25.8% for the segment, makes quite a strong case for Honeywell Aerospace, especially given the severe undervaluation of the business compared to its peers, which again we'll dive into in a bit. Once the business begins to trade as a standalone company, we're likely to see more value be unlocked.
So you talked a little bit about Solstice being spun off. You're talking about Honeywell Aerospace being spun off. And so is there a third spin-off, or are you just going to end up with the RemainCo, the original Honeywell, if you will, after the first two spin-offs? How is this whole thing structured?
Exactly. So it's a series of 2 spin-offs and then the RemainCo. So again, very, very similar to what happened with GE. You will have the Solstice Advanced Materials spin-off, which just completed. Late 2026 will be the separation between Honeywell Aerospace, and then Honeywell Automation will stay back as the RemainCo, along with other bits and pieces of the energy and sustainability solutions that was not spun off with Solstice Advanced Materials.
Interesting. Got it.
And even the RemainCo, and while I do agree with Elliott's judgment that the aerospace division might be the crown jewel of Honeywell, the RemainCo of the automation business segment still has quite a bit of potential. In recent years, their operational issues have been most pronounced in that industrial automation segment, which, as we mentioned, saw revenue decline by about 9% in Q3 2025. That's mostly due to 3 specific troublesome units that amount to less than 10% of total revenue, and it seems as if tides are turning in that sense. For one of these troublesome units, there was a single customer that terminated their relationship with Honeywell in mid-2022. Now that we're in 2025, the financial statements will slowly start to see that loss disappear and position that unit for growth. Another troublesome unit was the PPE unit, which has suffered as the COVID-19 pandemic has faded and has actually been reclassified as held for sale. So it looks like Honeywell is actively looking to get rid of the unit as well, lowering the bog down on the financials.
Interesting. So at this point, how do you value this business? That's the part I'm struggling with a little bit, to see how do I assign a value to each of these divisions and figure out if I want to invest before the aerospace spinoff happens or after, which is the decision we were trying to make with GE as well.
Yeah, exactly. So we dive a lot deeper into the valuation of the business in our December 2025 monthly newsletter on Inside Arbitrage, but a quick look at the valuation is as follows. So the median PE multiple for the aerospace division, and you can look at peers such as TransDigm Group, Heiko, GE, and Howmet Aerospace, as well as many others, is around 42. But using a more conservative PE multiple of 35, we can back into a segment valuation of around $110 billion. And this is based on the segment's 2024 profits and an estimated tax rate of around 21% based on the fiscal 2024 data as well from Honeywell. Now, a similar method can be applied to the RemainCo, with the median PE multiple looking at peers such as Rockwell Automation, Ingersoll Rand, and then Johnson Control Internationals, and many more, is actually above 35 times, but we're using a far more conservative PE multiple here of around 25 due to the automation segment's ongoing struggles. By combining profits from the building and industrial automation segments and applying that same tax rate, we can back into a valuation of around $72 billion.
That's interesting that, a PE of 35 would be considered conservative. But to your point, the industrials, the good ones, as well as the aerospace companies have been trading at pretty high multiples. Curious to see if that'll continue to happen or if they're going to pull back as a group. They are trading at pretty premium valuations at this point in time.
Right. I mean, the entire industry is trading at such a high premium valuation. So even as I myself say conservative PE multiple, I kind of laugh. But that in of itself makes the fact that Honeywell is so undervalued compared to its peers stand out more, and then once again makes the case for this business separation. So yes, is a PE multiple of 35 somewhat expensive? Yeah. But looking at peers in the industry, I think that might be the best way to value it. And then again, in our monthly newsletter, we look at a couple other multiples and back into another valuation from there. But continuing on, rather than valuing the remaining bits and pieces of the energy sustainability solutions business, we figured it's worth taking another look at a different part of Honeywell's business, their stake in the quantum computing company Quantum, which has just completed a $600 million equity capital raise in September of this year at a pre-money equity valuation of around $10 billion. Honeywell holds a roughly 54% stake in the business, meaning we can estimate a roughly $5.4 billion valuation for that stake. So it really shows that Honeywell has its hands in all the pies, including quantum computing.
Fascinating.
So this very back of the napkin sum of the parts valuation yields a combined equity value of around $188 billion, and with around 635 million shares outstanding and some intersegment eliminations, implies a per share price of around $288, a roughly 50% upside from where the stock trades at today at around $192. We dive a lot deeper into the math behind the valuation and then alternative valuation methods in our newsletter as well.
So, is this a little bit conservative? Doesn't spinning off assets tend to unlock more value than just the sum of the parts? I mean, the sum of the parts generally gets a bad rap because you hardly ever recognize the value from those parts. But here you are through the spin-offs.
Exactly. So the spin-offs are the way that you can actually look at the value of each of the parts and recognize those as separate publicly traded companies. And I think Elliott actually put it best in their letter when they said looking at similar situations at companies like United Technologies, GE, and Ingersoll Rand that also spun off major divisions and broke down their conglomerate structure, the upside potential was far more than what was initially estimated. Ingersoll Rand, for example, generated $100 billion of value from the announcement of their separations to today. United Technologies drove about $140 billion of value generation, and GE over $150 billion. In each of these cases, improved business performance drove both higher earnings and increased valuations, yet another benefit of spin-offs, because now you can focus exclusively on the company or the business segment as opposed to trying to deal with a massive conglomerate structure. And the same opportunity likely exists for Honeywell today. So the sum of the parts valuation could easily be a conservative estimate, even though we're using quite expensive PE multiples there.
Absolutely. I think we should take it one step further and run a few DCF sensitivity analysis as well to see what we come up with.
And with that, we will wrap up episode 47 of the Special Situations Report. What we covered today is just a brief overview of the special situations landscape. So if you'd like to access a more comprehensive weekly overview of all event-driven activity, go ahead and visit our website, thespecialsituationsreport.com. For daily updates and alerts on the special situations world, as well as access to tools to help you identify opportunities such as the merger arbitrage tool, check out insidearbitrage.com.
And if you enjoyed this podcast, please take a moment to like and subscribe on whatever platform you may be listening on, and especially share it with your friends who might be interested in special situations. Thank you.
We also wanted to provide a brief reminder that this podcast is for general informational and educational purposes only. The content does not constitute financial, investment, legal, or tax advice. We do not warrant the completeness or accuracy of the content or data provided in this podcast, and nothing discussed on this podcast should be interpreted as a recommendation to buy, sell, or hold any investment or security. Investing involves substantial risks, including the potential loss of principal. You should conduct your own research and due diligence before making any investment decisions. Thank you.